So the SEC has concluded through their GameStop report that nothing can stop the apes in what they want to do, or just retail traders overall. That's the general gist of this, but there is a video we're going to watch after I do read the conclusion to you guys that sums up everything that was said in this 45-page report. So if you don't want to read the 45-page report, I don't blame you. It's very long and complicated and just flat out boring. So I do recommend you guys watch this whole video so you can get the scoop on what is going on. Like I said, the overall gist is that apes cannot be stopped regardless of everything else. The ape, the retail investor, they have the power in the markets. So drop that like on the video, consider subscribing to the channel. My name is The Creative Investor. If you are new here, if you are interested in growing your net worth as fast as possible, well, you came to the right place. We do it all. I let you guys know the trades that I am looking at, the stocks that I am investing in. I keep you guys up to date, informed on the most informative information out there. So let's not waste any time. Let's get straight into it, and we are just going to read the conclusion and then get into that video. Basically, all you guys need to know is going to be in this video. Save you guys a lot of what you don't need to know. So conclusions: the extreme volatility in meme stocks in January 2021 tested the capacity and resiliency of our securities markets in a way that few could have anticipated. At the same time, the trading in meme stocks during this time highlighted an important feature of United States securities markets in the 21st century: broad participation. There are many different types of investors, and they buy and sell stocks for many different reasons. However, when share prices change rapidly and brokerage firms suddenly suspend trading, investors may lose money. No shit, right? Underneath the memes are actual companies with employees, customers, and plans to invest in the future. Those who bought GameStop became co-owners of a company through a system of mutual trust and participation that sustains our economy. People may disagree about the prospects of GameStop and the other meme stocks, but those disagreements are what should lead to price discovery and rather than disruptions. These events represent an opportunity to reflect on the market structure and regulatory framework and identify additional areas for potential study and further consideration in the interest of protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. These areas include forces that may cause a brokerage to restrict trading. A number of clearing brokers experience intraday margin calls from a clearinghouse. In reaction, some broker-dealers decided to restrict trading in a limited number of individual stocks in a way that some investors may not have anticipated. This episode highlights that integral role clearing plays in risk management for equity trading, but raises questions about the possible effects of acute margin calls on more thinly capitalized broker-dealers and other means of reducing their risk, aka Robinhood. One method of mitigating the system risk posed by such entities to the clearinghouses and other participants is to shorten the settlement cycle. 2. Digital engagement practices and payment for order flow. Consideration should be given to whether game-like features and celebratory animations that are likely intended to create positive feedback from trading lead investors to make more than they would otherwise. In addition, payment for order flow and the incentives it creates may cause broker-dealers to find novel ways to increase customer trading, including through the use of digital engagement practices. 3. Trading in dark pools and through wholesalers. Much of the retail order flow in GameStop was purchased by wholesalers and executed off exchange. They are talking about the market makers. They are talking about the citadels of the market, specifically Citadel and Virtue, that route most of the order flow, especially for these meme stocks. Says such trading interest is less visible to the wider market, and payments to broker dealers may raise questions about the execution quality investors receive. Further, through wholesalers increasingly handle individual investor order flow, they face fewer requirements concerning their operational transparency and resiliency as compared to exchanges or ATSs. Short selling and market dynamics. While short selling and calls on social media for short squeezes received a great deal of media attention, the interplay between shorting and price dynamics is more complex than these narratives would suggest. Improving reporting of short sales would also allow regulators to better track these dynamics. So that's literally the conclusion. that they gave us. Not too much to actually go off of there, but we're gonna go ahead and play this video. I'm not gonna be here at the end of it. It's about 2.5 minutes long, and actually today we're gonna have Gary Gensler on Squawk Box at 9:35 a.m. So definitely stay tuned for that. If you're not, I will be posting that, or what, you know, important details come out of that. I hope you guys enjoyed this video. I hope you guys got a lot of value out of this video. If you do, hit that like button for me. Consider subscribing to the channel. Check out the links in the description to support the channel if you want to, with free stock with Public and Weeble. Now let's get straight into this video. You guys have a great rest of your day. I will see you in the next video.
Some breaking news here on GameStop and the SEC. Bob Pisani with the details. Bob.
Hello, Sarah. The staff of the SEC has released a long-awaited report that focuses on the meme stock craze that peaked in January of this year, particularly the trading activity around GameStop. Now, what caused all that volatility? The report examined institutional accounts that had very significant short interest in GameStop, and it concluded that while short covering was a factor, it was a small fraction of the overall buying volume. The staff instead concluded it was positive sentiment, not short covering, that sustained the weeks-long price appreciation in GameStop. The commission staff did consider but rejected other explanations for the price rise, including naked short selling and a so-called gamma squeeze. Now, what, if anything, should be done? The report is long on facts, but it's short on recommendations. For example, the report noted that some brokers, particularly Robinhood, experienced margin calls from its clearinghouse when GameStop's price spiked up. The authors suggest shortening the settlement cycle, currently 2 days, to 1 day or less. The report also urged the commissioners to consider whether game-like features in trading apps might lead investors to trade more than they would otherwise. On the issue of payment for order flow, the report noted that the wholesalers who executed those orders did so internally, and so their trades were less visible to the wider market. On the issue of short sales, the report said that improved reporting of short sales would allow regulators to better track what happens when short sales do occur. Still, investors expecting some kind of imminent action from the SEC are likely to be disappointed by this report. This is a staff report. It outlines the facts, but it contains only very general recommendations on what the SEC commissioners might do. And guys, it doesn't contain any particular recommendations on what rules the SEC might want to enact in the future. Now, Chairman Gensler has spoken about payment for order flow and gamification of trading as talking points for months now. I think the issue with this report is, while it mentions this, it doesn't draw a clear conclusion and doesn't clearly show that there's harm from what happened in GameStop and, for example, payment for order flow or gamification of trading. We'll have Gary Gensler, by the way, the chair of the SEC, on with us tomorrow, 9:35 a.m. Eastern Time on Squawk on the Street. Guys, back to you.
Bob Pisani, thanks so much.